defer capital gains taxes. Defer capital gains taxes, how to enjoy the benefit of the pre-tax proceeds for an extended period of time, right? Maintain family wealth and enhance retirement. So a lot of us, we may not familiar with this terminology, but we're gonna hear from Mr. Greg so he can explain. And if we want something, we can reach out to him. I'm sure he's gonna give his name, his contact information at the end. And if you have any question, we're gonna answer this question at the end of the presentation. So grab a pencil, a piece of paper, and write it down, and we're gonna answer this question at the end of the presentation. Well, without further ado, let's put our hand together and warmly welcome Greg Reese. The stage is yours.
Thank you so much. Thank you so much. Hi, Benny. Nice to see you.
Nice to see you too.
Thank you for having me on today. Just the screen was frozen a little bit at the beginning, but I think it came back just in time. So I wasn't sure if you wanted to do any questions and answers throughout. I'm open to whatever makes sense. And of course, people could use the chat or they can do as you suggested. But it's my honor, it's my privilege to be able to share with you something that we are finding a lot of people are really interested in, because it's something that involves reducing taxation. Is anybody in favor of reducing taxes? Raise their hand. This is a very niche, it's a very specialized strategy that helps owners of appreciated assets who are looking to sell those assets to be able to defer the capital gains taxes upon sale, so that effectively they get to use the money that they otherwise would have paid in taxes directly for their benefit, whether that means to generate higher amounts of income for yourself or to accumulate wealth more rapidly, or maybe a combination of both, because you're not having to dilute your resulting investment nest egg with paying a lot of taxes out in the year of sale. So for example, this strategy can be used for assets that are several $100,000 worth of assets being sold to several millions or tens of millions of dollars. Let me give you a little quick overview of what this strategy is, what it's used for, some of the key benefits that I think that you might appreciate, and also, I'm open for questions as we move along. So what the strategy is called is the Deferred Sales Trust. The acronym is DST, standing for Deferred Sales Trust. So I may interchangeably say DST, or I may say Deferred Sales Trust. The Deferred Sales Trust is used by lots of people who are either looking to execute an exit strategy, to serve as an alternative to a 1031 exchange, or to serve as a rescue from a failing 1031 exchange. So everybody in the room here that might be listening, if you yourself or your friends, neighbors, family, clients are looking to exit from real estate, or they've built a business, a successful business, and they're ready to sell their business and retire. Maybe they have high value collectibles, things of that nature. The DST can be used to help them defer the taxation at the time of sale, which is extremely valuable and important. So let me go through those three things again. Exit strategy. That means that you have a highly appreciated asset of some sort, you're looking to sell it, and you don't necessarily want to reinvest back into the same asset or the same asset class. For example, if I'm selling my business, I may be looking to retire. I don't necessarily want to start a new business. Or maybe I'm selling real estate and I really don't necessarily want to invest back into real estate. Maybe I'm tired of being a landlord, or just it keeps me too close to home and I want to travel and I'm worried about what happens if I leave. And as the landlord, if the tenant calls or there's a problem, I feel like I can't be away for too long, just in case. And so that's really an exit strategy. The 1031 exchange alternative is one in which somebody is selling investment real estate and they were interested in maybe pursuing a 1031 exchange and buying more investment real estate, but the DST can serve as an alternative to a 1031 exchange in that the DST will allow the person, the investor, to park their money and wait for the right deal. Because if you're familiar with 1031 exchanges at all, you know that there's a very narrow window that you have to operate. Once you sell your property, you only have 45 short days to identify a replacement property. And then from that point, you only have a total of 180 days to close escrow on the replacement property. And if you don't achieve both of those, then you're going to end up failing and you'll have to pay taxes on the property that you sold. And so it's kind of a very stressful time for a lot of sellers that do 1031 exchanges, because you don't always know if you're going to find suitable replacement property in time, or whether the property you negotiate for is worth continuing to pursue, or if you can close in time. In other words, 180 days sounds like kind of a lot of time, but it's not really necessarily a lot of time. And there's a lot of things that can go wrong, including, in inspections of properties where you discover things that maybe are not quite up to spec, and maybe you don't want to take on the burdens when you discover defects and so forth. But what else are you going to do, other than pay the taxes? So to use the DST would allow you to have your money parked and take as long as you want to find the ideal, suitable replacement property, if that's your design and that's your goal, completely acceptable under our strategy. And if it takes 6 months, or sometimes, when you sell a property and you do a 1031 exchange, consider this: you're always buying into the same market that you sold out of. So if you sell when prices are high and you do a 1031 exchange, well, you're going to buy another property at the high price. If you sell when prices are low, guess what? You'll sell low, and you're also going to buy low, because markets don't change in 45 days, which is all the time you have to find a new property. But what if you think that because interest rates are climbing, for example, right now, and the value of real estate is actually falling as a result? What if you think the best real estate values are 6 months away, or 9 months away, or a year and a half away? You can't take advantage of the downside market cycle in a 1031 exchange, but you can in a DST. You could have your money sitting securely, tax deferred, and wait until the markets drop and get a much better value on a replacement property, if that's what you want to do. The third avenue, shall we say, that I mentioned is 1031 exchange rescue. So again, a seller of real estate looking to reinvest back into real estate, but maybe it doesn't work out. Maybe they can't find, the perfect property that you want to buy into in the 45 days. What if something happens and you can't close escrow in the sum total of 180 days? Well, normally the qualified intermediary, the 1031 exchange accommodator, would have to give you your money back at the end of that period and a 1099 so that you pay your taxes. If the DST is part of your strategy, it can serve as a backup role, so that if you don't find what you like, or you can't close in time, you can bail out into the DST, have your funds come from the accommodator into your DST, and now you have all the time in the world to be able to look for just the right property that you want. In other words, there's a phrase that, in my former career as a real estate professional and financial advisor, sometimes clients are doing exchanges and they find property that's not quite really exactly what they wanted, but in the short timeline, they kind of had to jump on whatever's available. And so I coined a term that basically says, sometimes you have to hold your nose and close on the escrow, even though it might not be the perfect property for you. So that's just a quick overview of what the DST is used for. Let me talk a little bit about the background. The Deferred Sales Trust is something that is not new, but it's still new to a lot of people. the background of this is that our tax lawyers, our tax team, developed this structure and the strategy utilizing Code Section 453 of the IRS Code. The code section has been around 100 years, so it's very well established law in the United States. And we've been conducting transactions with our strategy for 25 years. Over 25 years, we've completed well over 4,000 transactions, totaling well over $200 billion with a B, $200 billion. We've had IRS audits. We've had direct IRS reviews. We've had independent peer reviews by some of the top tax law firms in the country and CPA firms in the country. And FINRA has also done a deep dive review. I know a lot of you are financial specialists, insurance licensed, securities licensed, so you know who FINRA is as well. And all of these entities, especially the IRS, have done deep dive reviews and audits of our strategy and some of our clients. Not that many, but enough to give a good read on what's going on. Not one time has the IRS ever delivered a negative outcome for any client. It's always passed 100% approval by the IRS for 25 years. And you ask yourself, well, if that's the case, why have I not heard about this before? The simple answer to that is that the strategy is very specialized. You know, our team kind of crafted this and perfected it many years ago. But what happens is the IRS doesn't actually start to give you any scrutiny until you've done a lot of transactions over a fairly long period of time. The typical thing I see is if something relatively new comes along, the IRS will typically wait up to 10 years or so before they actually knock on the door and invite the proprietors or the sponsors to come visit with them. We'd like to talk to you. We'd like to spend some time. We'd like to review years and years worth of your transaction records and understand exactly what you're doing. They did that with us 12 years into our business model, 12 years. So it took 12 years before the IRS knocked on the door and says, would you mind sitting down with us and going over transaction records? And we said, we'd be more than happy to. What would you like? And they said, we'd like 10 years worth of transaction records. And I think you'll have to box them up and ship them to our offices in Laguna Hills, California at the time. This is back in 2008. And I said, and we'd like to meet with you personally, but we think it's going to take about a week going through that many years worth of transaction records. And so we said, absolutely. You can't fight City Hall and you can't fight the IRS. In fact, we had been waiting for just an opportunity for many years prior to that because we want the IRS looking at what we do. We want their blessing if they're going to give it. But of course, you never know until you get into that situation. So we got into that situation with them and they approved it 100%. They said, this is legal. It's complicated. No doubt, it's complicated. So not everybody can do it. Don't try this at home. But they said it does conform with the IRS code section. It is legal. And thank you for taking the time to allow us to examine it with you. They've done that with us individually 4 times, and they've audited individual trusts 16 times. And every single time they said it's perfect. No fines, no changes, nothing wrong whatsoever. And so that's the main reason why you don't find dozens or hundreds or even thousands of other tax attorneys trying to replicate what we do, because it takes so long for the IRS to finally examine it in depth and give you their blessing or their curse. Their curse would be, we don't like it, and we're going to audit all your clients, and we're going to tax them to smithereens, right? That would be the negative outcome that could happen. Well, people are afraid of that, and rightfully so. So we've got a great track record, and it's a perfect track record. And that's the main reason why you might not have heard of this in the past. Even some of your accountants, your CPAs, financial advisors, even your private attorneys, many of them still have not heard about the DST because it is so specialized. And so with that being said, let me give you a little bit of an analogy, if you will, Because it's new, I'd like to compare the deferred sales trust to a concept that everybody, I think, on this program is familiar with, and that is 401ks. Show of hands. How many people know what a 401k is and have a general understanding of how a 401k works? Well, let's do a comparison. Number one, the DST is a structure. Let me back up for a second. I want you to understand what this is. The DST is a specialized form of installment sale governed under IRS Code Section 453. 453, that's the code section. You guys are free to look it up, read it. Here's the definition of an installment sale under the code. An installment sale is any time you're selling an appreciated asset whereby you're going to receive some of your sales proceeds in 1 or more years after the year of sale. That's the definition. The rule set around that is that the seller only has to recognize and pay taxes on the amounts of money they receive in installments per year. So if you sold $1 million building or business, and let's just say you elected and you chose to take $100,000 a year for 10 years plus interest, you would only have to recognize and pay taxes on the $100,000 that you received each year, not the $1 million that you sold it for. That puts you in lower tax brackets. It allows you to use the taxes you would have paid this year or last year, whenever you sold, and have that money working directly for your benefit. Let me say it another way. Imagine that your favorite uncle came to you and said, I would love to give you a hand and a start in business and in life and an opportunity for you to grow your wealth. I'm willing to give you an interest-free loan of whatever amount. Let's tie it to whatever the taxes would be on what you're selling. I'd like to give you an interest-free loan of a couple $100,000, $1 million, $10 million, whatever it may be. And here's the terms of the loan. You don't have to pay interest to me. You get to use the money for as long as you like. You get to keep everything you make on that investment, and you have to pay it back to me someday, whenever you choose. And you can do it in installments, or you can push it out 10, 20, 30 years in the future and pay me back in a lump sum, or you can have your children or grandchildren pay me back. But that's the only condition. I won't charge you interest. You get to keep everything you make on this money, but you have to pay the original amount back someday. Who would say no to that offer? Seriously, nobody would say no to that offer. It's a tremendous offer. That's exactly what's happening with the deferred sales trust. It's as though the IRS is giving you a loan, interest-free, equal to the amount of tax you otherwise would pay. You get to use that money for as long as you want, pass it to your kids, let them do the same, pass it to your grandkids, let them do the same, with the understanding that you get to keep what you make on that money, but you have to pay the original money back someday. Oh, but there's another piece to that. If it turns out that you're not very good at making money and you lose all the money, then you don't have to pay it back. You don't have to pay it back. You have to make money. And if you make money, so you can take that $1 million or whatever it may be. What if you doubled it? What if you tripled it? Now you've got $3 million and you have to pay back your rich uncle, your friendly uncle, $1 million. You're still $2 million ahead that you would have never seen because you wouldn't have had that kind of capital to work with and invest and help your family. Okay. So that's a little bit about the DST. So let me take it a step farther with this analogy. Imagine you can sell your business, your real estate, your high-value collectibles, and the funds at the close of escrow come into a trust that acts in 5 specific ways as though the trust is acting like it's your personal 401k plan. So think of it this way. In a personal 401k plan, you get to make the decisions on how frequently you want to draw income from the trust or the plan to support your lifestyle needs. What are your personal needs for income? You get to decide how often and how much to draw. Number 2, You also get to decide or approve how the trust invests the money. Now, with both of those things, there's a lot of flexibility involved. In other words, if you decide on a certain amount of money you want to draw for yourself, let's say on a monthly basis, that's great. Well, what if your lifestyle needs mean that you need more money than you used to be receiving, and you want to change the amount you're receiving higher? You can do that. What if you need less money? You don't need as much money, to engage in the lifestyle that you desire. You can do that. What if you had an emergency and needed a lump sum? Could you access it out of the DST? Yes, you could actually. How about the investments? Are you locked into those forever? No. What if you have a great opportunity to change investments from one or two different things to something else because a great opportunity appeared? Can you have the money moved to something else? Yes. Can you change your strategy from something that's very aggressive to maybe as you're getting older to something that's more conservative? Yes, you can, or the other way around. So nobody makes those decisions for you. Our team helps you to get all the information you need, just like you enjoy with the Nine Fortunes team. They act as fiduciaries much like we do, in that we want to help educate you, discuss the options that you have available to you, the pros and cons, the risks and the returns, all of the information that you need to make good decisions for yourself and for your family. You get to make those decisions. The third comparison to the 401k is, as I said previously, you only ever pay taxes on what you choose to withdraw from year to year. So I don't care if in the background your investments made $100,000 this year in the 401k. If all you really need to live on for this year is $50,000, then you can choose to receive $50,000 and only pay tax on $50,000. The other $50,000 that was earned stays in that tax qualified environment, continuing to make more money for you and not being reduced by having to pay taxes. Isn't that amazing? That's wonderful. That's exactly what 401ks do. What about the legacy aspect of this? I mean, is this your asset or is it somebody else's asset? No, it's your asset. So you get to leave this asset to your designated heirs, your children, your family, whoever you want to leave it to. If you should pass away before you have withdrawn all of your money, of course you can do that too. But if for any reason you don't live beyond having taken all the money out of it, you get to leave it to whoever you want, and they have all the same options you do. They don't have to pay taxes if they don't need all of the money. Of course, they can cash it out, pay their taxes if they want. They can extend it for longer periods of time. They have so much choice and so much flexibility. The last comparison is asset protection. How many people are concerned in this state, in this country, about protecting the hard-earned assets that they've built over time? I'll be the first to raise my hand. I'm concerned about that. We have a litigious society. There's more lawyers than doctors, it seems like, and everybody's out to, takes everybody else's money and hard-earned, income and gains. The DST provides asset protection so that in the future, if you ever get sued and somebody comes after you, they won't get at the principal of your DST. It's asset protected as a byproduct of what we do. Okay. Now, I see that there's some chat coming, and so I think that's great. And I want you guys to just keep throwing some questions at the chat, because I'm giving you kind of a broad overview, but really quick here, we'll be able to get into Q&A and so on and so forth. But before I do that, I want to just share slight mechanics with you in a timeline and what is actually a suitable transaction where the DST makes sense and that you should probably consider it. Let's start with that. So the DST, in order for it to be economically viable for you, it's not based on the sales price of what you're selling. It's based on the amount of taxes we can help you avoid. So let's put it in these terms. If you were to be selling a business or a piece of property or some other highly appreciated asset, and the amount of taxes you would be subjected to without any particular planning involved would be at least $80,000 to $100,000 or more, that's a suitable transaction to consider using the deferred sales trust. Said another way, if the amount of appreciation that you're likely to pay tax on when you sell is at least $250,000, that's like saying the same thing a different way. That also constitutes a viable transaction for the deferred sales trust. So for example, what if I bought a piece of real estate for $500,000 and later on down the road, I'm selling it for, $800,000. That's a $300,000 profit. Does that qualify for DST treatment? Absolutely. What if I'm selling it for $1 million? Well, even more so, right? But what if I'm only selling it for $100,000 more than I paid for it? That might not be the best, strategy for you in that situation. So just remember, if your accountant tells you that you're likely to pay $80,000 to $100,000 if you sell without any planning, you should talk to us. You should talk to us, most definitely. Okay. So mechanically, let's talk a little bit about the timeline and the mechanics. So what we're doing is we're trying to bring our resources to you, become part of your financial team when you're selling. We're not representing you as the buyer or the seller's agent. We are there to provide the tax planning strategy for you. So if it's real estate or if it's a business, you're going to probably hire and work with a professional in that space, a real estate agent or broker, or a business broker, or mergers and acquisitions specialist who is skilled and trained and knowledgeable about putting buy-sell transactions together. What we're going to do is we're going to come into the picture at about the time that you put it on the market or you just received an offer. That's when you want to bring us into the team, because we need to structure our trust and our complete structure for you before you close escrow on that asset. So before it closes and changes hands, our strategy has to be in place before that date, if that makes sense. Now, mechanically, we can generally get everything we need done if we have 10 days to 2 weeks notice in advance of your sale. Sometimes we can operate quicker than that if you're like even a little bit closer to the end and you really, really want to take advantage of this. Oftentimes we can work faster, but that's our general rule of thumb and where we should come into the picture working with you. Now, here's what's going to kind of happen. You market your property with your professional, your broker or whoever. You entertain offers from interested buyers. You negotiate the terms of your sale with the interested ultimate buyers. You shake hands, you sign the agreement. Here's where we're at. Then we're going to create the trust for you, and our attorney is going to set the stage with the documentation that's necessary. And what's going to happen is we're going to enter into an option agreement with you, the seller, to have first right of refusal to buy that asset for the trust to buy it ahead of your buyer that you've negotiated with. But what's going to happen is right before the close, the trust will receive the asset, will hold title for about a minute and a half, very short, and then transfer it directly onto your buyer inside of that same escrow environment, so that the trust receives the proceeds of sale, not you, so that you don't have what's known as constructive receipt of the money, which comes with the obligation to pay taxes. So if you receive the money in your hands, that's when you have to pay taxes. It's just that simple. But what if a trust is in the middle between you having to receive the money in your hands? The trust has the money. The trust gives you a promissory note for the exact amount coming out of escrow and structures a promissory note with you where you get to define how much you want to start receiving every month or every year, when you want it to start, all of those features. You're in control of that, and we can change it at your discretion over time. So it's very flexible in that respect. And then the trust will go ahead and operate and hold the money and make those payments to you. And at the same time, you're going to say, well, I don't want the money just sitting in the bank not earning interest. What can we do with the money? Well, more than likely, you're going to want that money invested. And so our team, consisting of a tax attorney, a trustee, which is my role, and an independent licensed investment advisor, many of whom we work with as part of the Nine Fortunes group, are going to work with you to give you thoughts, ideas, suggestions, recommendations, and data, most importantly, information, because what did I say before? At the end of the day, you make the decisions. So I think one of the questions that came up a little bit earlier in the chat was, what kinds of things can the trust invest into? Well, there's no limitation or restriction on what the trust is able to invest into. And you know, it's as long as whatever you want to invest it into is a bona fide investment, right? So that could be financial instruments, stocks, bonds, ETFs, managed money, hedged money, passive real estate, passive investments in non-subordinated debt, private equity, private placements, REITs, Delaware statutory trusts, all sorts of things. Sorry for my light just going out there, but I think this is going to be okay. On the other side, the trust can also invest in active real estate. Let's say you want to buy an apartment or a building or a commercial building or raw land for speculation or investment, or maybe you want to do hard money lending. So there's really no limitation on what the trust can invest into, if you will. So let me see if my light will come back on. There we go. Sorry about that, everybody. And so that's a pretty unique opportunity, because if you think about it, there's really not that many provisions in the IRS code that allows you to mitigate taxes. One is a 1031 exchange, which a lot of people know about, and that's it has to involve the sale of real estate, and it has to involve the repurchase of other real estate. That's the only thing you can do there. You can do charitable remainder trust planning, but those are very inflexible, and once you make certain decisions up front, you can never change them. And you're also making one or more charities your ultimate beneficiaries, sometimes at the expense of your own children, because you can receive income from the assets that are sold on a tax-free or tax-deferred basis. But then when you die in that type of a plan, one or more charities, has to receive those funds. There are opportunity zones, which we could talk about. They're relatively new. They're not as thoroughly tested, if you will, because they've only been around since midway through the Trump administration. And there's the deferred sales trust, which is probably the most flexible strategy that you can imagine to consider for what you're looking to do. So somebody's asking a question, and I'm gonna weave in and out of some of these messages because sometimes they scroll up, I don't see them all, but somebody asked, does the title show the transfer between the seller and the trust? Also, could this work in all states? Well, let's start with where it works. It works in all states. This is based on federal law, and federal law has to be accepted in every single state. No state can say, oh, I don't like this DST. That's not legal in my state. They have to conform to federal law. States can't pass laws that are counter to federal laws. They can pass their own laws, sure, but they can't pass a law where something is legal under federal law and they make it illegal under state law. They can't do that. That's kind of a foundational point of our Constitution. The way the title might work, there's more than one mechanical way for this to work. It could involve, let's take real estate. It could involve where right before the close of escrow, your escrow or your title company or whoever will be instructed under the guidance of our tax attorney, as well as working together with your escrow and title people, as a team, essentially, that there may be a deed that goes from you to the DST, and then another deed that goes from the DST to your buyer, so the DST can receive the funds on the sale. Sorry. Sometimes if it's nighttime, my timer on my light doesn't work out well. Mechanically, another way, let's say you might own your business or your property inside of a corporation or an LLC or a partnership or something of that nature. We can work with any form of ownership structure and make this work. We can even make this work if there are multiple owners in a given business or piece of property where one or more of the individual owners want to use the DST, but others maybe don't. Maybe their share is too small. Maybe they have other capital losses. They can offset their gains. There could be different reasons why. But anybody that wants to use it, that qualifies to use this, can do so without having any implication or ramification on anybody else. Everybody can have a very friendly way of dissolving a partnership, if you will, and go their own way without, anything that you do negatively affecting your partner. Doesn't work that way. Nobody is negatively affected here. So it's easy enough to do that. So another method that we might employ is, let's say you have a corporation or an LLC. Our attorney might determine that in your situation, it would be most efficient, instead of buying the actual business or buying the actual property and taking the deed, that we actually buy out your shares in your corporation, or your membership interest in your LLC, or your partnership interest in your limited or general partnership. That way, the entity is still the controlling seller, the buyer is still the buyer, but then when the money comes into the corporation or the LLC at that moment, because it's triggered to be effective right before the close, at that moment, the trust now owns the shares that you used to own. So that way the trust can receive the money, so that, again, you don't have constructive receipt, right? If you understand how that works, the minute that money comes into your hands, it's taxable. So you want to have a protected reservoir to keep your money. That's the trust. And you get to draw from that reservoir for as long as you want, any way you want, in the amounts that you want. And you only ever have to pay tax on what you actually pull out of the trust from year to year, which is great, because the rest of the money is working directly for your benefit. Lump sums, and it's a question, we touched on this, but if you have the need for a lump sum, it is accessible. Let's remember one thing. All of the money that comes into the trust from the sale of whatever you sold, it's your money. I recognize that. You recognize that. Of course you do. The IRS recognizes that. Everybody recognizes that's your money. You can actually have it all tomorrow if you want it. But wouldn't you want to be smart about it? Wouldn't you understand that that's in a tax-advantaged environment, making money for you, not taxable until you withdraw it, just like it was your 401k plan. And, most people wouldn't go cash out their 401k plan the day after they retire from their job. They wouldn't do that. Why? Because they don't need all the money right now. They only want to take what they need to support their lifestyle, and they only want to pay tax on what they actually take out of it. So you can do that, and lump sums are available as well. It just means that, just like a regular distribution would be, if you want a lump sum, you can have a lump sum for your personal needs. You'll have to pay tax on it. That's all. So if there's an emergency, or you just determine that you and your wife want to buy a bigger house to live in, not a pure investment, for our purposes, buy a new home to live in. You want to buy a new home or a second home to live in. It's not an investment property or rental or something like that. And you want to pull out enough money to put a down payment, you absolutely can do that. You absolutely can do that. And you just pay tax on what you withdraw. It's that simple. Okay. So, and how long does it take to get your money if you needed something like that? Usually about 3 days. So it's pretty quick. The turnaround is pretty quick, and you can get to the money when you get up. Now, let's talk for a second about how things are taxed, because I know this is a pretty sophisticated audience, and you're involved in finance, real estate, lending, tax. There's a lot of smart people in this group. I know. I've talked to many of you. So the rule set around how you take distributions is this. The IRS determines that the first dollars of distributions that you want to receive from your trust each year are considered interest on your DST note, promissory note, to the extent that you would like to receive distributions that are greater than the accumulated interest on your money, then that extra amount would be considered a partial return of principal. So here's how it works. Let's imagine that you sell an asset for $1 million net. So you have $1 million that comes into the DST, and let's say your note rate is 5%. So that means that the trust would owe you $50,000 in interest for that year, 5% of $1 million, $50,000. So if you decide that you want to receive anywhere from $1 to $50,000 this year, that would all be considered interest on your note, on your promissory note. You will not have dipped into principal. You're just like collecting partial or interest only payments for yourself. That's fine. But what if in the same example, you wanted a distribution each year or this year of $100,000? Well, in my example, the first $50,000 represents interest on your note. You'll pay ordinary income taxes on that amount. The second $50,000 is considered a partial return of principal. That would be subject in part to capital gains taxes and in part tax-free return of basis. Basis is the legal term or the tax term used to express cost. What did I pay for that asset at the beginning? If I paid $500,000 for that asset, that's my basis. If it appreciates to $1 million, my capital gain is what? The difference between my cost basis and what I sold it for. So 500,000 is, let's say, my capital gain. If I withdraw 50,000 of that side, then I'll pay a portion of capital gains, and a portion of that will be tax-free because it will be a return of what I originally paid for that asset, if that makes sense. Okay. So that's essentially how the trust is taxed when you receive the money, but also the trust itself typically does not pay any taxes. The way we structure the trust and manage the trust with and for you, the trust typically doesn't have to pay any taxes. So the only time that you have to worry about paying taxes is based on what you want to take out of the trust every year. It's totally up to you, and it can change every couple of years, or whatever you want to do. So hopefully, and then just kind of going back on the chat, kind of weaving in some of the chat questions here. What happens to the trust after you die? Well, I kind of addressed that in my analogy between the 401k and the DST, right? So if you die, what we prefer to see you do is we want to tie the DST to your personal family estate plan. Most people are going to want to consider having a revocable living trust put together to manage and control and distribute your financial wealth to your heirs using a revocable living trust, so that your estate bypasses the legal probate process and the time and expense associated with probate. You would typically want to have a living trust in place. And with the living trust, usually the living trust will own your related various assets. It'll own the title to your house. It will own the title to your bank account. It will be on title to your brokerage accounts, and all of that, right? The living trust will own that. Well, the living trust will own your DST note as well. So it's just one of the assets that is controlled and held by your living trust. So if you were to pass away, it becomes an asset of your trust. It already is, but now it's for your kids' benefit, not yours, because you passed away. So they have all the choices that you had while you were alive. They can continue on with the same payment plan that you had structured to begin with. They can ask us to change the payment plan. They can look at the investment strategy, which might have been great for you, but maybe because they're younger, they're more aggressive, and they want to take more risk. Well, we can work together, and they can invest in more aggressive things if they want to. They can also cash it out without penalty or charge. They can also extend it. Let's say you have a 10-year note and you're at 9.5 years already, and they could say, wait, we don't want to pay the taxes in 6 months. What can we do? And can we extend it for another 5, 7, 10 years? Sure. But what if we want to cash it out within a couple of years after we do that? Can we cash it out? Yes. Will we pay any fines or penalties? No. Will we pay taxes? Yes, unfortunately, you'll pay taxes because you're receiving the money. It's just like pulling money out of the 401k. Once you pull it out, you pay tax on what you pulled out, right? So if that makes sense for everybody, okay. Let me kind of scroll up and see what other kind of questions might be in here. I hope so. Your company is a 1031 exchange company. No, we're not a 1031 exchange company. 1031 exchanges are really a competitive alternative to what we do. But the difference between what we do at a 1031 exchange is that, number one, with the DST, you can sell any kind of appreciated asset and defer the taxes. With the 1031 exchange, it only applies to selling investment real estate, not your personal residence, only investment real estate. And then what can you invest into after you've sold? With the DST, you can sell any kind of appreciated asset and reinvest back into any kind of investment. You can sell a business and go into real estate. You can sell real estate and go into a business. You can sell either of those things and go into financial assets, stocks and bonds and ETFs and equities and all of that, right? With the 1031 exchange, if you sell real estate and defer your taxes using a 1031 exchange, you have to buy real estate. And there are very specific triggers, and there's very specific rules that you have to follow, or it will not work. You will not be able to defer your taxes. And so which one's more flexible? Obviously, the DST is more flexible. So no, we're not a 1031 exchange company, but we do work with people that are exploring the waters of 1031 exchange. And if they don't find exactly what they're looking for in the 1031 exchange, then they can backstroke and come back and say, can I get into the DST boat? I didn't find what I was looking for over there. The market's a mess. Didn't find anything that I really fell in love with. Can I change gears and can I go into the DST before it's too late? The answer is yes. So we can be in a back seat for you. We can be a backup plan or a plan B, if you will. Okay. So that's something that's really important to understand. That this can serve as an alternative to a 1031 exchange and give you the ability to change gears in the middle of your 1031 exchange if you need to or want to. Okay, so that's pretty cool. So let's see. I'm going to go back to sort of the beginning. Vanny, that's probably not Vanny writing all these questions. No, I see a lot of different people on here. So we talked about what kind of investments are allowed in the DST, pretty much anything you can think of. The only thing that you really can't use the tax deferred money to invest in is things that are primarily designed only for your personal use and enjoyment, like buy a home to live in. Yes, we all consider that an investment of ours, right? But from the IRS standpoint, they don't consider that an investment for this purpose, right? If you bought a cabin on the lake and you want to buy a boat to cruise around the lake, spending money to buy the boat doesn't work. But I've got a client that sold a mobile home park, and they were big fishermen. They loved to fish in the ocean. So they decided to start a charter business where they took people fishing and created a business out of it, because that's what they love to do anyway. They said, we might as well make new friends and sell seats on the boat and take them out fishing and have a great day out there. And they turned a business into it. And we got to use tax deferred money to buy their boat, to buy the pole barn to store their boat, to buy a piece of property where they had their pole barn, and to buy the trailer, and to do marketing and create a website and all the things that you do when you start a business. And they got to use tax deferred money in doing it. And now they get to do what they love to do in retirement, which is fish every day. They just love to do that. So those are some ideas of what you or your clients might be interested in doing, because it's much better to have a larger amount of principal or capital to work with than to have to work with a reduced amount of capital because you've taken so much out of it to pay your taxes, right? Better to start here than to start there, unless you feel so sorry for the government that you just feel compelled, we got to pay, I should just pay the taxes, right? Because it's not like they tax you enough in this country, and they are going to, but don't worry, this is not a tax avoidance strategy. This is tax deferral. So someday you'll still pay their taxes. And that's what the IRS likes about this, because it's not like you're getting away scot-free from ever having to pay taxes. You will ultimately pay taxes, or your kids or grandkids will ultimately pay taxes. But you get to keep and use all the money until you're ready to pay your taxes, or until they're ready to pay your taxes. So everybody wins, right? We can still pay for the government programs we need. The government still gets their tax dollars someday, and you get to enjoy life more because you have more money to work with. Okay, it's sort of that simple. Very flexible. People are commenting. Yes, it is. Absolutely. And I thought you would like that. Let me give you an idea of the pricing on this. So our fee schedule is very standard and very transparent. So as I mentioned earlier, there are 3 principal fiduciaries that make up the fiduciary team for every DST trust we do. There is a tax attorney, which is one of our tax attorneys who are the architects, the developers. The intellectual property is theirs. They created this, the techniques, and they're the ones that have proven it out over time, 25 years with IRS reviews and stuff. And so nobody else is really competing or doing what we do. Then there's an independent trustee. That trustee role is an important role. That's my role. There's only 16 people in the country that actually are certified and vetted to play this particular role, to serve as a trustee for the Deferred Sales Trust. Only 16 in the whole country. I'm located in Southern California. However, I have clients all over the country, from Florida to Oregon, from California to Maine, and all points in between. And it's very rewarding. It's very worthwhile, because we kind of have a saying, or we chuckle. We say, friends don't let friends pay taxes. It's just that simple. If you don't have to pay taxes now, keep the money, live a better life, live your dream life, spoil your kids and grandkids by collecting more interest on money that you would have otherwise given to the government. Half the time they're going to waste and squander it. So, you be the steward of the funds until such time as you think it's time to start paying back a little bit of the taxes that you would otherwise owe to the government. So, fee schedule. We start every transaction, first off, as a conditional engagement agreement, meaning that you'll sign an engagement agreement with our tax lawyers, but you won't pay any upfront fee. The fee schedule will only apply at the end of the transaction if you choose to use the structure we create for you. So we take the risk upfront to create the trust, create the structure, interact with you and the other transactional parties. And if you elect to use our structure that we've created for you at the close of the transaction, then the legal fee for setting all this up will be a one-time fee of 1.25% to 1.5% of your sales price. So it's going to be a blend right in between there, 1.25 to 1.5% of your sales price, one-time fee. And they'll also stand behind it by providing audit defense protection for you for the life of your trust. In the event you're ever audited or your trust is ever audited, they'll defend it for you at no additional cost for you. It's built right into the agreement. The reason we do that, because attorneys don't typically do that. The reason we do that is we have a perfect track record for 25 years, and we'd kind of like to keep it that way. So you can understand, our attorneys, we all have a lot of skin in the game. It's in our best interest to make sure that we continue to operate with that perfect track record and have lots of oversight and compliance and things to make sure that we're following all the rule sets that we're supposed to. And there's a lot of great interaction and people kind of overseeing what I do. Quite frankly, I have people that oversee. I give reporting all the time and have people looking at every transaction that I'm involved in, because it's good to have other sets of eyes, looking at stuff. So that's the legal fee. On an ongoing basis, don't forget we have the other two professionals, the trustee and the investment advisor. The trustee and the investment advisor are typically going to earn a combined rate, not individually, a combined rate of between 1.1 and 1.5% annually on the amount that's in your trust from year to year. Okay. So if you had $1 million in your DST, you're talking about $10,000 to $15,000 in legal fees. But don't forget, if you had $1 million in your trust, probably about 300,000 of that would have been taxes that you wouldn't see. So what you'd have in your account is probably more like $600,000 or $700,000, right? You're going to have that extra $300,000, and even if it's earning you 5%, that's $30,000 a year. If our fees in the first year are maybe 10 to 15, and you're earning 30 on top of that for yourself every single year, you're way ahead of the game. You're making money on somebody else's money, Uncle Sam's money. You're making money on Uncle Sam's money. And so the value of that is pretty phenomenal. Once a year, the trust has to file a tax return. So we have to pay a CPA to do the tax return and send you your 1099 so we can report to you exactly what the tax impact would be when you do your taxes. And that's pretty much the extent of the fees. And so pretty straightforward, pretty clean. And, that's where it's at. So let's take another look here, because I think I'm probably coming up on the end of the hour. We've been about 58 minutes already. I can't believe I've talked this long. Thank you for your patience with me and standing put. So we just talked about the fee schedule. DST, does it include highly appreciated stocks or stocks and startups then go to public? Yes. The DST can be used for highly concentrated stock in private or public companies. Okay. So what if you had, 10,000 shares of Google before Google went public, or Apple before Apple went public, or just that many shares highly appreciated of any of those public companies? The DST can be used to help mitigate the taxes. Can we use it for cryptocurrency? Absolutely. I've done a number of transactions back when crypto was actually worth some money about a year ago. Had a lot of people take some chips off the table, tax deferred the profits that they made in cryptocurrency. Now we'll kind of wait and see if that market rebounds and comes back, because it's viable. You just have to have a certain minimum threshold. The only thing you can't use it for in the stock world is selling a broadly diversified portfolio. So most of us think of your 401k or just a diversified portfolio. If I've got 20, 30 stocks in a portfolio that I haven't touched for 5 or 10 years, and they've all appreciated, I can't really use the DST for that. You can't use it for that. But if I had a whole bunch of concentrated stock in Apple, Google, Netflix, you name it, or you had RSUs, registered stock options, things of that nature, or you took a private company public and the value of those shares went through the roof, could I use it there? Yes, because it's highly concentrated, right? It's all in kind of that one position, that one company. So yes, you absolutely could use it for that. Even some stuff that's offshore and out of the country. I mean, if you're a U.S. taxpayer and you've got assets in another country, you're still taxed as a U.S. tax-paying citizen, right? Even if you sell assets in India or Europe or wherever, you're still subject to U.S. taxation. So even if you had assets that are going to be subject to capital gains that you're selling that aren't here, we can still use it for those purposes. Somebody asked about step up in basis. So, step up in basis is a concept, mostly associated with real estate, but it applies to any appreciated asset. But step up in basis is where if you die owning a particular appreciated asset, the IRS allows what's known as a step up in basis to treat the new cost structure of that asset as of the date of your death. So if I bought real estate for $50,000 20 years ago, and it's worth $500,000 today, and I still own it and I die, then my heirs get to use a step up in basis to what it's worth when I die, $500,000. And so if they sell it, they would pay taxes on anything from $5,000 or less. So keep in mind what the condition is. You have to die while you own that asset. If you use the DST, you're actually selling your appreciated asset while you're still alive, are you not? Yes. And so if you sold your house before you died or your investment property before you died, you'd be subject normally to what? Capital gains. You only get the benefit of the step up if you die while you own it. So there isn't precisely a step up in basis in this. However, depending on what you would like the DST to invest into, let's say you wanted to invest back into real estate, and then you die while that real estate is still kind of owned in the mix, then yes, you actually could get a step up in basis on that. But you don't get a step up in basis on what you sold while you're still alive. I hope that makes sense. And we can always clarify, or you can ask your professionals over at Nine Fortunes or the Nine Fortunes team. So with that being said, if you're interested at all in learning more about the DST, or you or a client potentially have a potential transaction that you would like to speak with us about, my suggestion is, Vinny, Joyce, the team at Nine Fortunes, they are conversant in our strategy. They are some of my greatest partners that help to share this information and the strategy with people where it fits. And they're very good at understanding what strategies would work with a given client set of circumstances. Reach out to them. And so instead of giving my personal email or website or what have you, I will give you the website address, so you're free to learn more and research more about it. It's www.reefpointusa.com. REEF as in Frank, P as in Paul, OINT USA.com. reefpointusa.com. So you're welcome to take a look at that website. But really, if you want more information, let's start with the team at Nine Fortunes. They'll connect in with me. We'll schedule a time to talk with you, do an analysis for you on your particular transaction, so we can work together to see how big a fit this would be for you. How's that sound, Benny?
Awesome, Greg. Thank you so much for such a wonderful presentation. Honestly, we learned a lot from you, and I'm sure a lot of our audience got a lot of nuggets from your speech. I was waiting to see your screen. You have a PowerPoint presentation, but when you talk so clear we pay attention every single detail what you say. I think that's much better than see a PowerPoint presentation.
Well, I've got plenty of PowerPoints that I've put together that I do, but I find just talking to people.
No, that's awesome. I'm sure a lot of people, because they have so many questions in the chat box. So
yeah.
And
I
I'm sure
that you have a lot of people attending tonight. It's heartwarming to see that people are willing to stay up a little bit later to listen to somebody like me. So I'm grateful.
I like when you say that you have been in the industry for many years and you have audited from the IRS many times, and you passed the IRS audit, like, they congratulate you. That's a very plus for you and for our members to hear that. It's amazing. Yes. And about, advice, let the people know that having a revocable living trust before, to make sure if people die, they can have somebody take over the DST or something like that. So that's
an important component. I know you guys talk about that a lot because, in building your legacy planning for your family, that's a super important piece of that. And I know that you guys really stress that to your clients and know how important it is. So, but this is an example, and thank you for letting me kind of elaborate and share. This is how these strategies connect together. They all kind of fit, right? It's a nice way to this fits with that, to build your own little empire.
Exactly. And the important thing is for the family to manage the money and not let the IRS to touch the money. That's the important thing about the DST and all these financial concept planning that you share with the audience right now. I know a lot of people will reach out to you to find out more. And, I know people they're just going to say, I'm a Nine Fortune member, and you know.
And I'll know exactly. Yeah,
exactly. So, Greg, I really appreciate your time, and we give a very big round of applause to Greg for such a wonderful presentation.
Thank you.
We're looking forward to see you next time. I know Joyce is gonna let you know when it's gonna be the next time, so we can know more about your company and yourself as well.
Very good.
Thank you, Brad. Thank you.
Thank you, Joyce. Good to see you. I see you participating. Thank you so much. And
thank you.
Bless you all for all the good work that you do. And I'm just honored, to be in your company.
Thank you so much.
It's a blessing for us. So I'm very honored to have friends and associates like yourself. So thank you for allowing me to share tonight. I appreciate it. And you guys have a wonderful, prosperous start to the new year.
Happy New Year.
Okay, you too.
Yeah.
We'll talk soon.
Talk to you soon.
Everybody.
Bye now.